Global economic growth is fragile and diverging. Major economies are seeing vastly different inflation outcomes, creating a highly volatile environment for international trade. Advanced economies are operating under intense fiscal pressure. They are running massive budget deficits, which has kept long-term borrowing costs elevated and pushed ultra-long bond yields to near-record highs. In 2024, global foreign direct investment flows dropped by 11% year-over-year, excluding certain conduit economies. This is an environment of economic statecraft. Nations are explicitly using trade policies, tariffs, and export controls as strategic weapons to secure national interests. The United States has placed heavy export controls on advanced semiconductors. China has tightened licensing on the rare earth elements essential for defense and energy grids. And the European Union is rolling out the Carbon Border Adjustment Mechanism, effectively placing strict tariffs on carbon-intensive imports. Global supply chains are fracturing. When external demand weakens and free trade is restricted, economies built entirely on export-driven models face significant risk. Amidst these global headwinds, the Indian economy has maintained its status as the fastest-growing major economy for the fourth consecutive year. This sustained expansion is anchored by robust domestic sectors and a completely overhauled national statistical system. India's medium-term growth potential has strengthened to a steady 7%. Understanding this resilience involves the specific domestic sectors sustaining that 7% growth and the new statistical models built to track them. In an era where global trade is increasingly weaponized, a sovereign nation's defense relies on a vast, accurately measured domestic market. This pie chart shows the four main expenditure components of India's nominal GDP for FY26. Private Final Consumption Expenditure, or PFCE, is the primary driver, accounting for 61.5% of nominal GDP. This consumer momentum is broad-based, driven by a steady rural recovery backed by a favorable monsoon, and urban consumption aided by direct and indirect tax rationalization. These bar charts track gross fixed capital formation, or GFCF, representing overall investment. Data shows GFCF growth sustaining well above its historical average, keeping its GDP contribution steady near 30%. This is buoyed by public capital expenditure and revived private corporate investments. On the external front, services exports have provided a stable macroeconomic anchor, while goods exports remain sensitive to global tariff uncertainties. Even with global headwinds, total exports still maintain a 21.5% share of nominal GDP. The heavy reliance on internal consumption and capital formation ensures that India's growth is generated from within, providing a buffer against external trade shocks. These exploded charts display the production approach for gross value added. The primary contributor is services, generating 51.1%. The industry sector accounts for 24.3%, supported by improved capacity utilization and sustained capital expenditure. Agriculture provides a stabilizing force, contributing 15.2%. In the first half of FY26, agricultural GVA grew by 3.6%, thanks to favorable monsoons and consistent value addition from allied agricultural activities. This supply-side composition reveals a diversified economic base, where high-value services and core industrial output are scaled enough to offset agricultural fluctuations. Tracking an economy of this size requires precise data, but official quarterly GDP estimates inherently suffer from time lags. By the time the data is published, economic conditions may have already changed, complicating policy decisions. To solve this, the RBI implemented nowcasting. Its core is the dynamic factor model, continuously ingesting 17 high-frequency indicators. These streams pull real-time industrial production data, consumption metrics like vehicle sales and air traffic, and logistics parameters tracking rail and port cargo volumes. Finally, the fiscal indicator monitors gross tax revenues, providing an immediate proxy for corporate health and individual incomes. By constantly ingesting this high-frequency data, the RBI can publish an early estimate of GDP growth long before the traditional full-scale surveys are completed. Nowcasting replaces a reactive, historical assessment of the economy with a proactive, real-time radar system. Beyond real-time models, the government is expanding its structural data generation to map previously unrecorded segments of the economy. They have launched the annual survey of incorporated service sector enterprises. By utilizing GST network datasets, this survey generates granular, state-level data specifically on the corporate services sector. For household tracking, the next All India Debt and Investment Survey is scheduled for 2026. This is essential for assessing household balance sheets and identifying financial vulnerabilities. To complement this, a new National Household Income Survey has been designed using international best practices to map income distribution and measure how technology impacts wages. Existing tools are being upgraded. The labor force survey is monthly, and unincorporated enterprise surveys are quarterly. India's economy is rapidly formalizing and tilting towards services. These new instruments act as floodlights, exposing data in opaque layers of the market. The final pillar is rebasing. To ensure growth is measured accurately, the baseline years evaluating the economy must reflect current realities. The most significant update is the revision of India's GDP and industrial production base years from 2011 to 2022. The new GDP series introduces methodological improvements. It uses GST data to allocate regional corporate output and taps into e-Vahan administrative data to better estimate private consumption. Simultaneously, the new Index of Industrial Production will adopt chain-based indices and seasonal adjustments to smooth out short-term variations in the data. The Consumer Price Index is also rebasing to 2024, utilizing the latest Household Consumption Expenditure Survey and expanding to 12 distinct divisions based on updated international standards. Evaluating a modern economy on decade-old baselines leads to structural policy errors. Rebasing ensures the government's map actually matches the modern territory. When 61.5 Similarly, because fixed capital formation relies heavily on corporate investment, tools like the forward-looking CapEx survey provide the intelligence policymakers need to gauge private sector momentum. These surveys are now integrated with cloud-based platforms and computer-assisted interviewing. This cuts processing time drastically, delivering actionable insights to decision-makers in as little as 15 days. Sustaining macroeconomic resilience relies on continuous, high-speed data acquisition and precise policy adjustments. As advanced economies struggle with elevated bond yields and international trade barriers continue to rise, India remains insulated from many of these specific external shocks. This resilience is achieved through a self-sustaining cycle of robust domestic consumption and rising fixed capital formation. This internal momentum keeps the country's medium-term potential anchored at a steady 7% expansion. An economy exceeding $3.5 trillion cannot navigate global economic statecraft blind. With a modernized national statistical system, India now has the exact instrumentation required to safely chart its own growth frontier.